guys. Welcome to the Educated Home Buyer Podcast. I am literally running into the office. I am out of breath at the moment. We're looking at the wrong camera here, Josh. What did you do to my setup?
What?
This camera's
How did we get on the wrong camera? I turned the. What? How many cameras you got over there?
And then we're going to come in here in just a second, and we're going to change it.
Are you on the right mic? Did I do anything right with your setup over there?
What's that?
Did I do anything right with your setup over there? Are we on the right mic at least?
What did you do? Well, Josh, why don't you just have a conversation here? We've got some problems.
All right.
You take over.
As you can see, Mr. Jeb is coming in hot here from a home inspection in the the LBC, as they like to say, as the kids like to say, at least in the 90s, they like to say. So we're going to jump in once he is live. I got him all set up, but apparently I have him on the wrong camera and the wrong mic. So as soon as he figures that out, we'll get rolling on this. We're having in honor of last week's technical difficulties where it just cut out on us. Jeb was going to tell them that we have slide difficulties here this week. We got all sorts of fun stuff.
All right, we are good to go now, guys. So let's start off like we always do and talk a little bit about what's happened over the past week. So Jeb was gone last week, as you guys know. Thanks for allowing Josh to do his thing. I know a lot of you guys wish my wife happy birthday. For that, I am thankful. We were in Montana. Montana's a great state. If you haven't been there, I would recommend going. But since then, we've actually had some changes in the housing market that are positive, negative, depending on how you look at them. But we had pending home sales came out today, up a little bit, which is a forward-looking indicator, if you will, which I think most of us kind of know what's happening out there in the housing market. On top of that, we had some economic reports that were in favor of more bad news, right? So JOLTS came out, less jobs available. Today we had ADP reports, less jobs than expected. We had GDP revisions. All of these things pointed essentially to a slowdown in the economy, and with that, we've actually seen the 10-year kind of retreat a little bit, and rates improve. Josh, have we seen rates improve with any of this, or are we kind of bouncing doing the same thing?
Yeah, no. They've definitely improved, depending on which numbers you look at. Obviously, we had peaked. Some people were quoting some of the indices like 7.4, 7.5 last week. And for certain borrowers, if you locked on the absolute wrong day, it had got there. I have most of my clients locked. The ones that aren't locked, one is a financial advisor, and he watches this stuff closely. And he said he was willing to let it run to 4.33 on the 10-year, and he absolutely did that. And we've seen some recovery. So I didn't even look. Where did we end today, Jeb? 412 or 411? I
think 411, right? I didn't
411.
Look either. 411.
411. Yeah. So we are super close to a layer of resistance there. If we get through that, we have probably another 8th improvement in interest rates. But something that will be interesting as we watch this and go forward is if we take out a couple of the next technical levels, they will improve. You want to say a lot, but what does that really mean? It takes us back to the high sixes. So no one's going to get excited about a 6.625 or a 6.75 interest rate.
Well, they will if they're currently getting quoted a 7.5.
Exactly. If you're in the market right now, that is exciting. If you are wanting to get in the market, I don't know if that's going to jump you off of the fence or get you to jump off the fence, I should say.
No, but I mean, again, it's all stuff that we're paying attention to. What we've talked about for the better part of 6 months is, a slowing economy is going to allow the Fed to kind of back their foot off the gas pedal, slow things down a little bit. And with that, you should start to see some easing in rates and that sort of thing. We haven't seen that. We've actually seen strong economic data, report after report. Is this the formation? Is this the start of slower and slower economic news? Hard to say, right? It's, a couple of reports, they're pointing to the right things, the things that we thought we would have gotten a couple of months back, but it's hard to say without seeing, more than one of these reports, in back to back, if you will. Hard to say if we're seeing a trend or if this is just a one-off, but jobless claims tomorrow. and then BLS. So we get the labor report on Friday, which is really the big mover, right? If the BLS numbers come in less than expected, so less jobs out there created, even if unemployment doesn't really change, I think that's, again, kind of shows the Fed things are slowing. And again, that doesn't mean rates drop immediately. It just it puts another layer on the cake of a slowing economy. And what you need is that cake to continue to get bigger in order to see an improvement in rates. But
Well,
Josh,
Jeb,
even with that said, go ahead.
I almost threw in a slide of the 10-year treasury going all the way back to like about this time last year. Because as we all know, from the beginning of 22 all the way through November, it was pretty much a straight climb up. We had a couple of little corrections, but nothing, no relief in sight for rates hiking. And around November is when we started seeing the first signs of improvement in inflation. And everyone said, oh, okay, rates have peaked. They're going to get better. The Fed wanted to see inflation improve. Well, around the first part of the year, they started saying, well, not exactly. We also want to see employment cool off because employment is likely to lead to higher wages. Higher wages will keep inflation higher. So we need to see both of those things. We got a little bit of relief in February and March with the banking crisis, but then the Fed went back to aggressively talking about jobs. Then we've had a couple of funky ADP reports, Jeb. The 2 reports back was where we had that monster 500,000 jobs created. We've seen both in JOLTS and the BLS stuff, some things that don't jive and don't necessarily make sense. Some of the super smart analysts that dig into this data are saying things with JOLTS. We've talked about jobs being posted, one job being posted in multiple parts of the country for jobs that can be done remotely. There's some talk that within JOLTS, they're also changing. An employer may post a job 3 or 4 times with different keywords to get different applicants. So there's could be problems with the methodology in JOLTS. We've talked about the demographic side of the jobs market. We have an aging population, people leaving the workforce. We have low workforce population relative, workforce participation relative to the rest of the industrialized world. So those things are going to keep employment tight. But I think we are absolutely going to see over the next few months that employment is going to get worse. And it's still going to be really strong. Like, again, we've talked about previously 5 ways to go to get 5%. But if you take a bigger, more macro view of the employment situation going back to early last year, it isn't nearly as tight as the Fed has thought or worried. And once you take that away, it's going to become apparent fairly quickly that rates need to decrease. We're going to go through that in my slides. So really, it's not a question of if, it's a question of when. And I don't have the answer to that. I don't think you do either, Jeb. But rates are going to be coming down. It's just a matter of, is it in the next 2 to 3 months? Is it in the next 12 to 24 months?
Good stuff. So with that, we're going to dive into some charts here in just a minute. What I would like you guys to do that are listening is if you have questions, start putting them in the comments now. It allows us to kind of flow right from the charts into your questions. You guys get the most out of the show. Probably why a lot of you are here is to get your question answered. That helps. Also, if you haven't checked out the Educated Homebuyer podcast, separate from this channel, it's a deep dive into a specific topic in real estate. Go check it out. There's a YouTube channel. We're on Spotify, Apple, all those places, getting quite a bit of traction. But I think we're right about 1,990 subs or so on YouTube. Would like to hit 2,000 tonight. So if you haven't subscribed, go and consider doing that. Subscribing here is also very welcome. But with that, Josh, we're going to dive into this information here. So my normal inventory chart from Altos this week, for whatever reason, they didn't put it out. I've been using that chart for the better part of a year, and this is the first time they have not put out that chart. But with that said, we still have the numbers. So what we saw this past week is inventory rose from 496, 541 to 503, 159. Roughly 6,600 homes came on the market during this period of time. Again, not what we would like to see this time last year. Again, we went from 551 to 554, so 3,000. And this is about the time last year when inventory started to peak, which tells me that we're probably close to it again this year within a couple of weeks. So we're likely going to see inventory peak here really, really soon. But back in 2015, we were sitting at 1,216,000 homes. So less than half of where we are today. Orange County, 2,381 homes. So down 60, 70 homes from last week. HB down to 196. We were at 201 or so last week. So again, those numbers are trending lower here locally. And what we know is that new listings saw a considerable drop this past week, right? So we didn't see inventory really rise because new listings are dropping. Now you're watching this going, Jeb, you just said we went up by 6,600 homes. How's that possible? Homes are sitting on the market longer, not going under contract. Therefore, inventory there is building. And you do have some new listings coming on the market, just not, at a pace that is going to to make a considerable difference in the numbers out there. That said, Josh used this little trend last week. We're bringing it back this week. And you can see that we're still below where we were this time last year with regards to inventory, and the trend is down, right? I mean, from where we were, we're still well below the trend in inventory, which is what we've been talking about for some period of time. This is a chart I found interesting from John Burns. Just shows the percentage of sellers who have switched from wanting to sell their home to listing it as a rental property due to higher mortgage rates. So, this was kind of titled as what's bad for buyers and for real estate agents is people wanting to keep their homes and not actually sell them. That there's, could be truth to that, but it's not going to help the market when people have super low rates and wanting to keep them. Here in Southern California, nearly 11%. Nationwide, somewhere around 7%. So that keeps inventory low, and that keeps, again, that flooring in the housing market, Josh, keeps support there for higher home prices just because of that lack of inventory. And that's why we're seeing Case-Shiller and some of these, start to report housing prices increasing again.
To give some context to that, this is anecdotal and it's not applicable to many parts of the country, but have a client that was referred by an agent friend of yours. Talk to them. They want to buy about $1.4 million. They thought when they were going to move up, they would move up to about $1 million, $1.1 million. And lo and behold, they look up and their house is worth $1.1 million. They owe about $550,000. So they're going to walk away with about $500,000 to put down on it. And they're thinking is exactly what that chart says. You know what? We have a 3.25% interest rate on it. We got a ton of equity. Let's take out a second and rent the thing out and then buy another house. And when they looked at what that was going to do, both in terms of reducing the cash flow because they need to pull some equity from the other property, and then the monster payment on the new home with a much smaller down payment, and they backed away and said no. And I see that a lot. Wouldn't see enough of these situations to say it's 50-50, 60-40. A lot of people have the idea, and it's a very good idea if you can pull it off. Most people can't.
No, and most people want the cash. Like, they don't like the idea that it's tied up in a property. They get scared with the idea of owning another property, having to manage it, having a property manager manage it. It's too nice to be a rental. Like, there's so many things that people go through, and I get them all. That they all could make sense in the right framework, but at the same time, they could also look, you look back 20 years, you're really glad you kept the property. So it's one of those things that you got to kind of do, what's right for you. But nevertheless, Case-Shiller, 0.7% monthly, annually, kind of sitting at 0% here. And we're going to look at some other charts here as well. FHFA came out with theirs, 0.3% month over month, 3.1% appreciation nationwide year over year.
Jeb, with that, people like to ask the question, why? Why are those two different? They're both paired sales indexes. We like to say, don't look at median, look more to the FHA or the Case-Shiller. Case-Shiller is looking at all sales. FHFA is only homes that are sold with financing to the GSEs. So it doesn't pick up jumbo loans and it doesn't pick up cash sales. So this is where the majority of the activity is happening and where we're seeing more bidding wars. What you may also pick up in Case-Shiller is cash buyers. Cash buyers may be getting a discount. That could be why in their index, you're not seeing quite as much upward price pressure. It's why we like to show you guys all of them, including NAR's median house price, because they all tell you a little bit about the market.
No, good stuff. And something else to mention here, Josh, we talked about the podcast earlier. I don't know how many of you guys watch Minority Mindset. Minority Mindset's great financial channel, has a lot of really good information out there, talks about different aspects of finance and financial freedom, business, housing, credit, just kind of everything, all encompassing, if you will. super smart dude. But he put a video out about the idea of homeownership not really building wealth and how it doesn't build wealth. So Josh and I took that on today in a podcast, and it's going to come out next Tuesday. And we actually talk about the idea that does homeownership really build wealth? And we talk about it being a liability and all the things that go along with it. So if you like that sort of thing, make sure you check out next week's episode. It'll drop on Tuesday on YouTube, on Spotify. So make sure you check it out. This past week, Josh, what did we talk about? I forget.
Our interest rate's going to 8%. It's
We talked about
less of
interest
a question
rates,
now. We'll see what
and
happens tomorrow and Friday, but less
really
of a
good
question
episode.
now.
A lot of really good feedback on it. If you haven't checked that out, make sure you're checking that out as well. So this, Josh, is home prices turning higher. So this is different. What do we call these? Different. What do we call companies?
Indices.
What do we call them?
Well, there are different indices. There are different just experts. I mean, really.
Yeah, I mean, we'll call them different things. How's that for complexity? No. So we got Case-Shiller, FHFA, CoreLogic, Black Knight, Zillow. These are all, I wouldn't say housing, and they're all housing related businesses, if you will, that do business in the in the housing industry, and they all put out forecasts and what have you. But as you can see from this chart here, and if you don't see the chart here, there is a link in the description below. I did update it, so you might have to refresh. If you're listening on audio, it's in the description as well. But showing what's happened thus far this year and what the expectations are. And look at Zillow and CoreLogic saying a pace of 10% appreciation in 2023. Seems pretty crazy. But we do know that home prices have increased, and there's likelihood that the next couple of reports are probably going to show some increases as well, especially, based on what's currently happening out there in the housing market with inventory and, et cetera. So that said, Josh, we'll go on to this one. Again, another view just showing National Association of Realtor versus Case-Shiller, year over year. Appreciation, NAR showing about 3%, 2.5%, 3%, somewhere in that ballpark.
And again, NAR reports the median. They're not really doing any analysis. They're just looking at the number and saying, what was the midpoint figure?
Yeah. And I found this chart interesting, basically just showing national home price decline by months. So if you look at the housing crash in the 2000s, it took nearly 70 months for basically to reach the bottom, if you will. Whereas the pandemic correction took, I can't see not even 10 months, 8 months or so before you saw the V-shaped recovery. The early 90s correction was a little bit more, maybe 11, 12 months. But just kind of shows you, month over month declines, where we were then versus what's happening now. Everybody wants to talk about 08 and reference it, and really we're not even close. Job openings. So this is what we talked about to start the show. Sort of sitting 8.8 million, somewhere in that ballpark, Josh? Is it? I forget the exact number, but just showing that job openings are declining from basically the middle of the pandemic there.
And that trend line you threw in there is the important part. We're right where you would expect to be after this long period of above trend job openings.
There you go. I didn't throw that in. I just stole the chart and it had it in there.
You stole the chart of someone that drew the trend. Perfect.
Hey, yeah, it's perfect.
I gave you credit, Jeb. You did it.
And this is the ADP numbers that we talked about earlier. Again, ADP is one of those things because they've been so off the last couple of months. I think the market's kind of looking at ADP going, what the hell do they really know? And that's why we didn't really see a mover this morning in the market when the numbers reported. I think you just kind of people shrug it off. I think there was a little bit of improvement, then it came right back because people are going, well, we got the real numbers in 2 days. We'll just wait till those come out. But if you look at this chart, you do see decline in those numbers over the last couple of months. And this is the real GDP that we talked about earlier, revised to 2.1%. I think the expectation was 2.4. So again, slowing economy leads to, less volatility in the market, which ultimately leads to lower inflation, right? Because less economic growth, which again leads to lower interest rates. So Josh, here we have deficit, rates, and wages. So what are we looking at here? Or the economic composite, really?
So yeah, that the economic composite, it's a figure that takes into account what's happening with wages, what's happening with GDP, what's happening with inflation as measured by CPI. Those are all trending down. You can see that red line. They spiked very, very high, way above trend. That was bad. That's why we have much higher interest rates. They're coming down rapidly. You see the 10-year is still going up despite the fact that that's coming down. That cannot and will not happen over the long haul. Either the 10-year turns and starts coming down, or you're going to see that composite index going up. So we see month after month after month, wages are coming down. GDP came in at 2.1. A few weeks ago, Jeb, we had the Atlanta Fed GDP nowcast saying 5.8. People freaked out. Yep. Oh my God, the economy's hot. Ignoring the fact that it comes down about 3% by the end of the quarter. We're not experiencing a hot economy. You can look around, you know that, and that tells us that the 10-year will be coming lower. The Fed will intervene. Again, Jeb, this one here shows interest payments. We've shown this a million different ways, but interest payments is a percentage of government revenue. That is off the charts. We are moving up towards 20% of government tax receipts is going to be going to just paying interest.
A fifth of
they have to figure they have to figure out a way to get that moving lower, because the debt service on the national debt just doesn't work. This kind of shows this one here, Jeb. We are right here where the dotted line is, where it says growth trend of debt. That's where we are now. This goes forward to 2047. Those numbers are astronomical. They're showing the federal debt at 2050 as $135 trillion. Like, that's insanity. We were like 6 or 7 when Obama took office. To give us context, that was a while ago now, or two more presidencies beyond that. But this is a wild number, and that it cannot continue. So the government has got to figure out how to decrease the growth rate of the deficit, and then figure out how in the heck to keep rates down so that they can afford the debt on it. A lot of these are just telling real similar stories. Look at that slope. Look at that trend line. The 10-year GDP average growth rate. It has decreased, and we've talked about this a million, billion, trillion times. The more debt the government takes on, the more money goes.
Sounds like the debt. Million, billion,
exactly.
Trillion.
The more of tax receipts go towards non-productive purposes of just paying interest on the debt on things that have already been spent. It will decrease GDP. So looking at that, you are going to see lower growth, whether we like it or not. So anyone saying that we have a robust economy that's going to be humming along above 2% growth is out of their mind. Interest rates, a function of economic growth and inflation. Look at everything coming down except for the 10-year. GDP coming down, inflation coming down, 10-year still going up. Cannot happen over time. This will be reversing. The only question is when. This one here, again, the reason why I showed this here, the analyst that put this together is literally making money bets on this. I've doubled my treasury bond ETF TLT position in my personal investment account this week, given that global central banks and government politicians cannot afford high inflation or a defaulting economic cycle. The pressure to suppress rates will continue to increase. The math provides a clear roadmap for the future. It's not to say that any one expert is correct, but this isn't the only person that we're following right now that is saying they are making heavy bets on treasuries right now. Interest rates, this is again just a composite index directly towards interest rates. Interest rates keep going up, the composite index is coming down. That cannot happen over the long haul. So unless you have a formula for how wages growth and CPI increase, it's just not going to happen. The only reason I threw this one here, I don't think the chart is super helpful, but again, same analyst saying, should such occur, the risk off rotation would cause a drop in rates towards the pandemic era lows. He's not calling pandemic era lows. We actually got down to 0.6 or 0.35, something ridiculous on the lows on the 10-year treasury.
Is that a mirror?
Yeah, it's just showing the TLT prices and then the 10-year yields.
It is inverse 100%. It's crazy. Yeah.
So what he is saying is a decline that he is projecting would get you a return on an investment. If you just bought the TLT, it would give you a 50% return. You can buy that at 2-to-1 leverage if you're bold. I don't know if either Jeb or I are bold enough to do that.
I used to trade options on that thing. I don't anymore.
This one here, you guys like to ask, hey, how's business? How are things going? So you don't have to ask anymore. This will show you U.S. mortgage application sinks to the lowest since 1995. The fun part is we talk about how people like to lie with headlines. The headline this week is going to be mortgage applications up 2%. Well, when you're at a, what are we talking, a 30-year low, a 28-year low, a 2% increase doesn't do a whole heck of a lot for you. From week to week, they've been chopping shopping around, but volume is low. There is virtually no refinance business because the only one refinancing is someone that has an awesome need for money or a desperate need for money. And then
that's
when you're looking at,
and that's a good place to plug my episode for Friday on this channel. And that's, I talk about basically the idea of refinancing, to pull out cash, to get rid of mortgage insurance. I go through basically causes to do it, not to do it. So if you're interested in refinancing, thinking of refinancing, check out that video on Friday.
this one, I actually, for my newsletter that'll be coming out this Saturday, threw in a chart of looking at, this is what rents have done as long as it's been tracked. There's some breaks in the line there, but say going back to the 50s, rent increases have averaged 3.7% per year. And if you look at that, we have never had a period where they turned down. You might want to claim that post great financial crisis there, they were flat for about a year and a half. So we hear a lot. This is not to say, hey, don't be dumb, just go buy a house. It's easy. It is not easy. But I regularly hear people tell me, why would I go buy a house? It's way cheaper to rent. Went through an example of a $500,000 purchase, depending on where you are in the country. That could be high, that could be low. You would pay about $1,000 a month premium right now to own that versus renting. That will be disappeared within 10 years, at about 9 years, with 3.5% growth in rents. And it's actually averaged 3.7% going back 75 years. Rents are not going to decrease. The owner, on the other hand, in that situation, that $500,000 mortgage, 5% down, they have about a $3,800 mortgage. $600 of that every month goes towards principal. So it's a $3,200 net payment. And then when you look at that, Jeb, that grows over time. So by the time you get to the end of the 10 years, the rent is actually higher. And at that point, you're paying about $700 or $800 a month towards principal. So you have a net ownership payment of about $3,000 versus owning of $3,900. So I thought this was important. People just, I don't think people know what this chart looks like and what it tells you what renters have to look forward to. Doesn't, again, make it easy to go buy a home, but it tells you owning with a 30-year fixed mortgage is your only shelter from shelter inflation. This one, Jeb, why don't you go through, because you've had your chart and your technicals lined up on that chart, but why don't you walk through where we are in terms of these key levels right now?
Yeah, I mean, I don't have it up at the moment. I can pull it up, but I look at technical analysis, not necessarily for the bond market, but for stocks. But it translates into, looking at channels and calling technical analysis and patterns and what have you. And not to brag or whatever, but I honestly, I've been pretty spot on with where I thought these were going to go. And we've kind of hit those numbers. So looks like at the moment where we're sitting at 4.11 is kind of a support level in the sense of bonds moving higher. And so if we can break through this level, it looks like we'll go down to again, about 4.09. And then I have it at 3.8, right? So kind of along the same lines as these numbers, maybe a little bit off on secondary decimal point, but nevertheless, I mean, I think there's a really good opportunity to see the 10-year trend lower towards the bottom of that channel, just based on where things are at the moment. And with that, that means you get positive economic, well, not positive. Depends on how you look at it. You get worse than expected job numbers basically tomorrow and Friday. I don't know actually how much tomorrow is really going to matter with the numbers coming out on Friday. So even if you saw something tomorrow, it probably is kind of a standstill until numbers are reported on Friday. But if that happens, you could see things move down to at least 4, in the low 4s, 4.09, 4.08, somewhere in that ballpark. And then if it breaks that down to 3.8. So again, we're talking, rates moving down another quarter, 0.3% type thing, not 1.5%, not 2%, nothing crazy like that. So I think if anybody's out there watching this going, hey, all of this stuff is immediately going to change the mindset of the Fed, that, maybe it changes their mindset a little bit in how they talk into the media and what they report in their next Fed meeting, but you're not likely to see any meaningful moves until you get consecutive reports back to back.
And remember that Fed speak is a policy action. Them signaling and saying they're going to be hawkish and aggressive is as good as doing it. And if they get a little more dovish and say some things like, hey, things are looking great. We think maybe early next year we're going to be able to drop rates. The market will trade that, and it will start doing it right away. We actually had a comment from one of the viewers here. Couldn't find it, Jeb, but saying that Powell is saying that they're just going to raise slower at a slower pace going forward. And that is not at all what he said. I've got the quote here from last week in Jackson Hole. He said, although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we're confident that inflation is moving sustainably down toward our objective. So the inflation numbers are there. If you look at 3 months, look at 6 months, look at the shelter components and everything that feeds into that, the inflation figure is already there. The only thing that could hold it higher is wages, which we actually have a comment from Kim here that she just got a raise, but the raise is helping her keep pace with inflation, not actually putting more real dollars in her pocket. So that will tell you our academic economists, PhD economists, how out of touch they are. They're worried that you're going to be getting raises too high and you're going to rip out and buy a bunch of stuff. So we are at or near an inflection point here. And that's not to say that things are going to get terrible. We're going to get a big recession and rates are going to dive, but we are at or near an inflection point here where growth is going to be low. You're going to see worse jobs numbers. You're going to see inflation continue to moderate and interest rates are going to normalize. The $24 million question, Jeb, is what is normal? What is normal?
No,
we haven't seen normal for 15, 20 years.
No, exactly. And again, I think all signs pointing to a slowing economy. Look at where rates are on car loans. Like that, if that doesn't stop you from buying a car, then you absolutely have to buy a car. Like there's no world in which anybody wants to go out and spend pay 8-9% for a car loan. It's insane. I mean, the last car that I financed, I think my rate, I got at 0% financing. And then the other one I paid like 1.7 or something. Crazy. I mean, yeah. Anyway, you're going to see the economy slow. And with that, inflation is definitely going to come down and the Fed's going to have to intervene. So Alex comes up with a comment and said, I thought technical analysis, pseudoscience, astrology for stock traders. So there's a belief out there that it's like, hocus pocus. And to some extent, it's a bit crazy, but here's what I will tell you is that when you look at technical analysis and you read it, trend lines and different technical patterns always work out. It's kind of like, if you ever wonder how market makers or bookies make, wages on games, and it's like a 1.5 point spread and somebody wins by a point or a point. It seems crazy, right? I mean, you're looking at what does a 0.5 point matter on it matters. I mean, sometimes it doesn't matter at all, but more often than not, all of those things matter. And it's kind of eerie how they all work out. And what happens with technical analysis a lot is when you looking at a chart and something is reaching a top, reaching a bottom, bouncing somewhere, there's always some economic news that kind of happens about the same time that kind of pushes it in the direction that more or less you thought it would go. And so this is one of those times that I wouldn't say put all your eggs in one basket and that's what you pay attention to, but it's something you don't ignore either. And I think that's the key. All right, Josh, we're 35 minutes into this now, and finally going to start taking on some questions from you guys. So if you find any value in what we just did, hit the thumbs up, right? It again shows us that you appreciate that part of the show. I realize it's not the Q&A. It's not the live Q&A that we talk about a lot of times, but it is information that you need to know if you're considering buying, considering selling. I mean, you don't even need to be buying a home. This is stuff this is not the media, right? We don't have an agenda, so to speak, with giving you that information. It is literally just the information. You do with it what you want. Now, we are reading between the lines a little bit, which the media is not doing, right? But there you go. All right, Josh, which question do you want to start with this evening?
Well,
I saw one. Go ahead.
Go ahead. Do it.
No, I saw, I believe it was one of our regular viewers here asking a question. And she said, what was the question? Hold on. I'm sorry. I'm trying to find it. It was along the lines of why I believe it came from Dina asking, why is the government, here you go. If the world economy is hurting, how could America raising rates help us? So right now, the Fed, again, not continuing to raise at the moment, but saying that, it's not out of the cards, right? It's something they will consider. So why would our Federal Reserve consider hiking rates at a time when all of the charts that we just showed more or less shows a slowing economy, Josh?
A good question, and I also don't have a great answer for it. There's an interplay, and I'm just, again, brain is a little foggy. Would need to go and research to get your right answer. But what we're seeing is there can be currency manipulation more so than interest rate manipulation. We're talking about potentially China, with them wanting to prop up their currency. The yuan has lost value relative to the dollar. And what they're talking about is possibly selling some of their treasuries. If they sell their treasuries, it should push our interest rates higher and would strengthen their yuan against the dollar. So there's some of that stuff that goes on behind the scenes, but I don't really think that anything is being done by our Fed or our government saying, hey, let's raise interest rates. It's going to somehow strengthen our economy relative to the rest of the world.
Okay, I read the question differently than you did. I took her as raising interest rates, meaning raising the Fed funds rate. And the reason the Fed would do that is to slow the economy, right? So all the data that we're showing you is real-time data. A lot of what the Fed looks at is lagging data to some extent, and in the way that they interpret the data, and they're not seeing the economy slow as much as they would like to slow, right? Inflation is still above the 2% target. Looking at the Lena GDP, you had it, GDP at 5.9. So they're looking at that going, still a really strong economy, not the slowing economy you're talking about here. Therefore, we've got to keep doing this in order to slow growth, because by slowing growth means less, income, less money floating around out there, driving up the cost of goods, which is what we're trying to prevent. And therefore, that's the reason they're doing it. So they're doing what their goal is. One of their mandates as the Fed is to, stable employment and more or less inflation, right? And so by doing what I thought you were asking, which I could be completely reading that wrong, and Josh could be reading it correctly, is that they're just basically trying to slow the economy for that reason. So maybe one of us is right, Josh. I don't know which one. Proxia. Those like Michael Bordenero screech that refinancing a few years after purchase isn't truly cost effective. What's the true cost savings of doing so?
I love it, because out with no numbers, no context, there's no way to answer this question. So anyone says, hey, you cannot come out ahead refinancing after a couple of years. Cool. How much did interest rates move? Did we go from 7.5 to 3.5 and I saved 4%? I could pay a lot for that refinance and come out ahead. Did rates move from 5 to 4.5 and I got a $112,000 loan? Probably never going to come out ahead on that refinance. So anyone that throws out crazy answers like this, like, oh, you can't come out ahead, the numbers never lie. You need someone that can pencil them out for you. It's largely a function of the size of the movement down in interest rates and the size of your loan as to how much you will benefit. And on top of that, different cost structures for different lenders. We can do a refinance for less than $2,500. My average loan amount is $500,000. That's about a half point in costs. If you're dropping your rate 1%, you make that up in about 6 months. So it's not hard doing a break-even analysis. There's about 9,000 spreadsheets or websites where you can plug the information in and get that. So anyone telling you just random shit out of their mouth like that, it doesn't make sense. We don't know what the opportunity to refinance is going to look like in the future.
There you go. Well said. Rihanna Keeves. Josh is feeling his hair today because he's not wearing a hat. Look at that. Josh, he just got it dyed.
I went and got it did. Yeah, I went to the beauty salon, spent a couple hours.
He got it dyed. Got all the gray out of it.
Hey, listen, young man, you're the gray one. I've got the gray in my beard. You've got the gray on your head.
That's all right. We'll just bring it in. Red Apples Kim. Josh, paying off credit cards balances will increase your credit score, not your personal loans paid off. True or false?
Revolving will have a much bigger impact than installment debt. In general, when we do a what if analysis, or when I've had someone come in and say, hey, I just paid off my car, I just paid off a $10,000 student loan, we see very little to no improvement in the credit scores. Someone pays off or pays down revolving debt, it will make a big difference. We have some really big changes coming in credit scoring, credit requirements, credit bureaus and models that we're going to be able to use. We're still probably about 2 years out, and that may change because they're looking back further in time, where you can't just pay something off and see this bump to your score right away. But as of right now, you're 100% correct.
All right. Pulse Powered came in early and asked a question. Anything cooking in the background on when and what the qualifications for the new CalHFA down payment assistance friends are waiting on the sidelines? So anything there, Josh?
No, nothing. So you and I both saw that it's technically been approved, but it's really, the funding has been approved, but it's, hey, go back and fix the program. So I worry for anyone waiting on the sidelines for that program that they're expecting it's going to come back the way that it was. It was a terrifically flawed program. The majority of the funds went to households that could have bought otherwise. It didn't make homeowners out of people who couldn't have bought otherwise. It allowed people to buy more expensive homes. So from that perspective, I expect it to be a lot tighter in terms of who's eligible to qualify, and you'll probably have some bigger limits on how much you're going to get. Rather than a 20% down, maybe we see a 10 or a 15% down, so more families can be helped and more families that truly need it. Because I can tell you, a lot of people that qualified didn't necessarily get the program. They didn't get something under contract and get to use it. But I'm looking at this going, this is silly. Why would the state be giving this person a 20% down payment to use when they can absolutely buy without it?
There you go. Good stuff. And yeah, we don't have any information yet. They just, again, like Josh said, it's been approved. So anybody thinking it's going to follow the exact same guidelines, is probably being misled. I don't think that's going to be the case. So, but we will know probably come election time. No, I don't know. As soon as we know, clearly there'll be a video. We'll talk about it here and give you the info you need. Josh, there was, so I'm going to answer this one real quick. Orange Pulp says, any information you can give me on buying a condo for my parents? Need more info. Like, give us more to work off here and we can have a conversation. Really hard to say though, right? Each person's situation is a little bit different, but give us some more context and we'll see what we can do with that.
Jeb, an interesting point that most people are unaware of on that. If you are buying for a spouse or a child who is a parent or a child who is unable to provide shelter for themselves, so homes are too high priced in the area for them to buy with their Social Security, that can be an owner occupied loan. So you can own your home owner occupied. You can get another owner occupied loan for either a parent or a child who is unable to qualify for themselves. And they don't have to be on the loan. They don't have to co-borrow. You can actually be the only borrower on that for them. We do have to document that they don't have the ability to qualify on their own.
There you go. All right. Let's see here.
Jeb, this is a comment and not a question, but this kind of relates back to something that you and I talked about recording the show today. Anya says, in theory, a home value will double in 30 years. Well, we have no idea what's going to happen going forward, but we use the example. My aunt bought her house here in Huntington Beach in like 1974. And when she sold it, I think they paid $50,000, and it went up 700% by the time they sold it over what it was like mid 90s. So in about 20 years, it went up about 600, 700%. So my home I bought in 2000 and we paid $580 for it. It's worth just less than triple that. So about 300% increase in way less than 30 years. So I think that trend is going to continue, that you'll see lower and lower returns on homes. But if you figure a doubling in 30 years instead of a tripling in 20 years, probably a pretty reasonable guesstimate on it. Jeb and I were reviewing an analysis. The guy that does the calculated risk blog, he was going through and talking about real returns on homes. So how much has your home appreciated above and beyond inflation? And going back a long time, you are getting a real return by owning a home or multiple homes over a long period of time. It's not a myth. It's not magic. It's not to say that everyone should go out and buy a home today immediately, or that everyone can go out and buy a home today immediately. but owning a home will lead to greater wealth over the long haul, because it's the only leveraged investment that you're going to put a small down payment, control the whole thing, and it is going to grow at greater than the pace of inflation going forward.
There you go. This one's really easy. Where is there any unused land near Orange County? It seems like there's no more large swaths of land for building around here. So you got to go south and go east, or north and go east. There's not, right? I mean, anything coastal, within 15, 20 miles of the coast is pretty much gobbled up at this point. You got to go to less desirable areas, right? You got to go to places where the land isn't flat, where you got to build in the, in hills and that sort of thing in order to use it. Requires more work, requires more building cost. And with that, it's, you're getting further and further away from the epicenter. And that's why you got new developments out there, like on the way to Palm Springs, Beaumont, and some of these areas. Like, 20 years ago, people said, who the hell's going to live out here? Well, guess what? A lot of people are living out there now. Same thing with Vegas and the outskirts of Vegas. You gotta go and where it's buildable. They've obviously done it correctly, because most of these communities are selling and selling pretty quickly.
Well, Jeb, you had mentioned the other week something that happens. We've had 2 schools here in Huntington Beach. The school district sold off the land. So you have things that are used for other purposes. Schools are uniquely well suited for that, because the buildings on the land are pretty insignificant relative to the amount of land.
Yep. No, that's good. I mean, in fact, I would say, I can't do the calculation off the top of my head, but I would say 3 or 4 of probably the last 10 communities in Huntington Beach have been old school districts. I mean, old schools. Actually, at least that, maybe more than that. I can think of 3 right off the top of my head. They were all developed in the last 7 years or so, that were old schools and converted. And now Westminster Mall,
and the houses are really expensive.
Oh, very expensive. Like one they just did in South Huntington. I mean, those are starting at 1.9 million. I mean, it's not affordable for most people. Westminster Mall here, right? I mean, people have been talking about redeveloping that for the longest time. Hey, let's tear it down. Let's build housing. Guess what? It's in the plans to do that. But guess what? It's all apartments. It's not going to feed any new residences for people to live in. They're going to keep essentially you can go out and find the plan online, but more or less the center of the mall is staying. And they're building like a community out there, and it's apartments and shopping and just kind of this different thing. There's going to be a park there and all of that. But what it doesn't do is it doesn't help the housing situation for people wanting to own homes. It just feeds, the apartment, the rental side of things. All right. 207 people listening at the moment. If you find any value, do us a favor, hit the thumbs up. Also, I know a lot of you guys are always, wanting to talk to Josh, wanting to talk to a lender in your area. There's a link scrolling the bottom. Get in touch with Josh there. If you're looking for something West Coast, if you're looking for a lender in another state, that will direct you, to somebody we know, like, and trust that can guide you through that process. Also, if you need a real estate agent, that link will get you there. As I mentioned earlier, I do business as a real estate agent. Fortunately, just put four transactions under contract in the last week, which is nice. So if you're looking to buy a home, sell a home, I can be of assistance there. Would love the opportunity. So you can reach out to me directly. If you like podcasts, check out The Educated Home Buyer. If you like this channel, hey, just stay here. That all works too.
So Jeb, is that then the answer to the question, the specific question from Noe64 wants to know, do you do real estate in Riverside County?
It depends on where it is. I'm not going to be your guy regardless. I have somebody on my team that works Riverside that understands that market, knows that market better than I do. But you essentially get me when you get somebody on my team, because, we're all working together for a common goal there. So yes, the answer is yes, just not me directly. But if, you need help, we could chat. Trabuco Canyon, OC land sell, too tough to build. Big deal there. Fire is your enemy, really, in many ways. And Trabuco is one of those areas. Insurance is very difficult to get, probably more so now that all these insurance companies are backing out of California, some of the major guys out there. So I think is probably too difficult too tough. Depends on what your definition is. I just don't know if the cost benefit analysis makes sense to do that. So yeah, my thoughts on that one. Josh, here, we'll just answer this. Jeremy, still feeling good about 6% rate at the start of 2022. I see a lot of bank lenders are still forecasting that rate. I think you could see something in the low sixes, right? I mean, clearly I'm not afraid to be wrong. I've been wrong multiple times. I do say that I think that's reasonable just because I think inflation numbers are trending in the right way. I think rent shelter data is going to start to report a little bit more significantly here over the next couple of reports. And with that, less volatility in the market, lower rates. Yes, I'm going with yes.
When we did the episode that just came out on Tuesday, we're sitting here going, hey, things escalated quickly. We went from 6.5, 6 3/4 to 7 1/4, 7.5, super fast without a whole heck of a lot of provocation. That's kind of why you've seen in the media so many articles written about what is going on here. Not a lot changed, but they spiked very, very quickly. They can just as quickly and easily go back the other direction. We had a little bit of sort of correction last week that was kind of just, hey, maybe it was an irrational hike, but not that rates shouldn't be that high, but maybe they got too high too quick. This week that we've seen Monday, Tuesday, Wednesday, 3 days of good data that have pushed things in the right direction and a fairly good correction. If we see good data tomorrow, in terms of PCE, if we see good data Friday in terms of jobs, we're going to see some follow through here and keep moving down. So from that perspective, there's clearly a formula for it. If you go back to the slides at the beginning of the show, there is nothing that I'm seeing that says hot economy, high growth, high inflation, higher interest rates. Yet here we have them. That tells me they should correct. The wild card out there, and we will watch going forward, but I just closed out the chart here, is what happens with energy, primarily oil. But oil's still down 10% year over year. It's up 10, 12% from the middle of the year when we were at really low levels. So for those of us in California, have geniuses in California that run our government. We also, Jeb, I got to see that I think we've had 58% appreciation in our electricity costs in California over the last 3 years. That's been a fun one also, thanks to our wizards in Sacramento.
I always love the wizards comment. We do have a bunch of wizards. Not necessarily in a positive way. That said, Josh, I was going to say something. I want to address this question, but I'm going to address it in 2 ways. I'm going to answer the question, but I'm also going to bring up something that I hear a lot and just heard it this past week that we need to talk about. I have primary home and a rental. I want to move my rental, make it my primary, move into my rental, make it my primary. I'm 55 plus. How do I move my tax base from my primary now to my rental, or can I? So let's address that. So can you move your tax basis from a property that you own to another property that you own? I don't believe that you can. I believe that they had to be bought in, you have to own that property and then move it. You have 2 years, I think, to move that tax basis to a new property that you purchase. Now, I might be wrong on that, but my understanding is you can't have owned the property and then move the tax basis. Josh, do you know any differently on that?
I don't. I was going to ask if you do. I'm fairly well versed in this stuff, but that question kind of threw me for a loop because I haven't had a client deal with that and research it. We can definitely do it and circle back next week.
Yeah, let's go back on that one because it is a really good question. But I have had a similar question before with somebody owning 2 pieces of real estate wanting to transfer the tax basis, and it was they couldn't do it. And I thought it had to be purchased after or during a certain period of time in order to make that happen. But we'll circle back. Now, the second thing I want to address, go ahead.
I was just saying, when was that, Jeb? Was that pre or post Prop 19?
Probably pre, because Prop 19 is about a year and a half old.
I'm wondering if Prop 19 changed it. I'm not saying that it did. I'm saying it may have, because I'm pretty sure pre-Prop 19, you're correct that you could not.
Yeah, so we'll get answer on that one because it's a really good question. But second part of this, and where I hear a lot of issues, and this isn't related to property taxes so much as it is taxes in general. There's a belief out there that when you sell your primary home, as long as you take whatever the gains are in that property, let's, for example, use a really simple example. You bought your house for $100,000. It's now worth $1 million. crazy, seems asinine. It does actually happen. But let's say you bought it for $100,000. It's now worth $1 million. If you're married, you get up to $500,000 in tax-free gain on that property. If you're married and you've lived in that home for 2 of the last 5 years. Okay, we're giving a really simple example. You might have a crazier scenario. Talk to a tax professional. But let's say in this example, $500,000 in tax-free gain. And let's say you did absolutely no improvements to the property. You have no selling costs, to make this really, really simple. So that means you have $400,000 there that is essentially taxable. There's a belief that if you take all of that money and put it into a new property, that there are no taxes to be paid. That's not true. That is prior to capital gains exemption that they put in place back in whatever the year was.
Yeah.
I don't know what the year was.
Long time ago. It was the 90s, I want to say.
That's how it worked. If you took your all of your gains and you put it in a new property, no taxes. That's not how it works anymore, guys. So you get a certain amount that's tax exempt. You get to factor in improvements and selling costs and all of these different things. But if there's any other gain, you get taxed on that gain. I mean, I have a client right now that bought her house for like $40,000. It's worth roughly $1 million. She's single. $250,000 is all she gets, plus any improvements and all of that. So there could be a large percentage there gained. So just understand all of this stuff before you put your home on the market and you get an offer and you're not in a position to back out. You go through the whole process, talk to a CPA, talk to a tax professional, and make sure you understand the recourse of doing some of this stuff. Because again, I hear it enough to know that it's common that people actually believe that. And it was that way at one time.
26 years, Jeb, 1997, 26 years. And yet people still have that misunderstanding. Probably the second biggest misunderstanding of that, Jeb, is they think it is, what did I pay for my home? Less what do I owe now? So let's say you paid $600,000 for your house and you paid it off. They go, I got $600,000 of gains. No, you paid $600,000 for your house. It's what has it gone up? And there are things that can add to your basis. So your basis is probably higher than what you paid for it. So definitely something that you need to get professionals involved to help you come to that. And Jeb,
and this goes right along that same thing, Josh, asking, can't you do a like kind exchange? So what a lot of people get confused with 1031. So 1031 is when you have an investment property and you sell that investment property and you roll it into another investment property. In that case, all of your gains can be rolled into the new property and there's no taxes on it. Because, and that's a like kind exchange. That's what we're talking about there. You take a residential property, you roll it into another residential property. Those are like kind investments. It's a 1031. Obviously, there's certain rules. There's a tax code that goes along with that. There's certain things that you have to abide by in order to not be taxed, and it's pretty strict. So make sure, again, you talk to somebody that understands this and truly before doing anything crazy. But yes, that's what we're talking about there. So when you're selling investment, going into investment, you can avoid taxes up until the point you sell that property. Now, if you leave it in a trust and do different things, there are ways to, avoid taxes, so to speak. But, again, that's a whole different conversation, a whole nother episode. But
in this situation, Jeb, if you wanted to get real crafty, you move out, rent out that property for 2 years. In that situation, you've still owned it. You still lived in it as your primary for 2 of the last 5. So you could take up to 500 tax-free, or you could do the 1031. It gives you all of the options.
Yeah. I mean, if you have family and a trust and you don't need the money and you're going to end up giving the property anyway, the best way is to leave it in a trust, because your beneficiaries can get the step up basis in it. And that's a huge, huge benefit. That's what we're talking about, generational wealth there, guys. I mean, that is really where it comes from. So 6 o'clock now, Josh, we'll go a couple minutes over. We started late. We talked a lot. Let's just kind of keep flowing here. I got a child to pick up at some point, but we'll
one of those expensive little creatures.
We'll get him when we get him. All right. He starts middle school, dude. He had registration today. So he got his classes, all of this stuff. Crazy, bro. He's in middle school. What is going on?
It seems like we were just rolling up the Hogue to meet the little thing.
Dude,
now it's going to.
Let's not go there.
Hey.
All right. What do we got? I'll start crying, bro, right here on air. You guys want to see Jeb cry? I can do it. Just start talking about, sentimental things. I'm an emotional guy. You guys don't get that. I am super emotional. I am the epitome of empathy and just
The
sadness.
the laughter
Sadness.
you're hearing right now is his wife
Uh,
just howling down the street while she's listening to this.
Too funny. Too funny. All right. Where do we go here from here, Jet? Here you go. Kim's got a question. Is there a website for fixer uppers? Not really, not that I'm aware of. Any of them out there aren't showing you all of them. They're, a portion of the fixer uppers. Again, fixer uppers in this market, you're not really getting true value like I think you're wanting to with a fixer upper, because those are getting picked up by investors, flipping them, that sort of thing. Speaking of which, if you have any properties that you're looking to that are flip opportunities, reach out to Josh and I. We're looking for some deals here. Looking for some deals.
All of the ones we're seeing are $1 million to start with. So we would like something a little lower price point, but we're not against $1 million home if it was the right deal.
If it's the right deal, that's always the right deal.
Jeb, there's
Yep.
a good one here, and it came in early, so hopefully clips some easy still here. Is this a good time to buy a house for a family that is very well qualified, but they can wait 2 more years? And my question is always, wait for what? What's going to change? What's going to be better in 2 years? Something that I've been reading and rereading and reviewing here recently, The Psychology of Money by Morgan Housel. Whole chapter in there on the power of compounding and how the best thing you can do is start early. Other things being equal, you want to own a home as early as possible so that you benefit from more appreciation over the long haul, that you're doing your principal reduction and you're paying it down faster. Every year you're paying less interest and more towards principal. So that accelerates, the appreciation accelerates as the value goes higher. So I would just have to hear a really good reason why we should wait. You always have the option to refinance to get a lower rate. You would just have to tell me that, hey, I have some keen insight that tells me I'm going to be able to buy at a lower price in the next 2 years, which we showed the chart at the beginning of the show, Jeb. No one is predicting that at this point other than YouTubers.
Yeah, I mean, 2 years out, let's just say, for example, home prices did drop by 10% in 2 years. They dropped by 10%. Well, if you looked at that report, Zillow is expecting 10% in 2023. And then I think the last report, they're expecting another 6 point something percent from July of this year to July of next year, 6.4% or something crazy like that. So the longer you wait, the more you need it to drop to get back to where you are today. So can it happen? Sure. Anything's possible. Is it likely to happen? No, it's not, unless you see something major happen across the economy that leads to mass layoffs. And I mean, just like you would have to have another 1929 event type thing in order to see that, in my opinion, within 2 years, just based on where inventory and stuff is at the moment. I mean, even if inventory doubled right now nationwide, you're still not even back to 2015 levels, which again, rates weren't this high back in 2015. So demand would slow, prices would come down, but I don't think you'd see, anything close to what we saw back in 2018 at that point. I'm sorry, 2008, not 2018. All right, Josh, we are an hour and 2 minutes on. Let's get one more question here, and then we'll say our goodbyes. What do you want to?
These folks love to know what's going on in the current market and what you're seeing. Obviously, this is just for you here in Orange County, but you said 4 transactions under contract.
Yep.
On those experiences recently, how many offers were people making to your listing or you making on a property to get them under contract?
Okay, so one listing I've had on the market for better part of 130, 150 days at this point. I mean, it's been a while. We started too high. It was listed at $1,475,000. My recommendation was $1,425,000. At the time we listed it, we did get an offer around $1,425,000, but it was a contingent offer. Seller wouldn't accept contingency. It's a relocation. Relocation wouldn't allow it. Long story short, we received multiple offers during that period of time, from $1,375,000 to $1,405,000, blah, 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 blah. We put it under contract at $1,400,000, which, based off where it should have been priced after that many days, pretty good price. So that one went under contract. So we've had multiple offers over that period of time. One offer right now, we had 2 a couple weeks ago, fell apart, whatever. that's that. Buyers, buyer in Long Beach. We put in multiple offers for them. A couple of different properties. The first 2 to 3 properties, we were one of, hell, I don't know, 15, 20 offers on them. Bid solid offers, and some of them were priced at, like, one was priced at 865. One was priced at 889. Both of those we came in at 925. Both of those sold over $1 million. That gives you any idea. We were able to go under contract with them, did the home inspection today. That's where I came from. They were a multiple offer situation. We ended up going $35,000, $40,000 over the asking price, kept our appraisal contingency in place, didn't do anything crazy, and we're under contract. So we'll see where that goes. Another buyer, downtown Huntington Beach. They're buyers from Canada. They're cash buyers. They've been looking for something with not an ocean view, but on the water-isk. There's not really things on the water here in Huntington outside of one community. They don't want to consider it because of laundry situations in that building. But nevertheless, they want to be on PCH-ish area. Found something that just came on the market, went under contract. That one was priced at $920. We got it accepted at $910. So compromise there, a little bit less. It only been on the market about a week, and they put in multiple offers. We've been outbid several times with them, doing very strong things, and they just happened to find a property that was outside of the building that they were willing to consider, and we're there. And then my other property is the sellers of the buyers in Long Beach. They're selling their condo, and we got full ask on that. And so we had a couple of different offers, a couple of different showings, and we went under contract immediately. So all that in a nutshell, guys, market is still very competitive, even with rates where they are today. I've got buyers that we put in an offer last weekend, actually the last 2 weekends down in, what the hell is the name of that community? Ladera Ranch. And one was priced at $1,300,000, and the other one, I can't remember, somewhere around there. We offered $1,350,000 and $1,355,000. One went over $1,400,000, and I don't know where the other one went. They didn't tell us. So
I have clients at nearly every price point, and they're getting in multiple bidding situations. And you almost know the ones that super competitive situation. We had a client here in Orange County that started at 700. They're up to 850 now. 850 is like, for a single family, that's entry level, and everyone that doesn't want a condo is going to be making an offer on that house. So what I can say, I was on a call last night, the vetted VA call, with 3 other loan officers from around the country. Most of them in Texas are not dealing with multiple bidding situation, or if they are, it's not brutal where you're not able to get a home. Colorado appears to be doing better. So it's all anecdotal. And
Absolutely.
Again, considering price points, but those guys have very similar clientele that I do. And I can say closed one last week in Idaho, have a buyer in Portland that they're having a little bit better luck than what we're having here in Southern California, at least at the entry level price points. So from that perspective, it's interesting. So Jeb, we have an interesting opportunity for those 218 of you that are still here and left, and maybe we can bribe them if we answer more questions. Those who have not gone over to the YouTube channel, like Taylor Swift, we have 1989. We have 1,989 subs. So in the next 24 hours, we're going to go over 2,000. I would love for one of you folks to be our 2,000th subscriber to the podcast on YouTube.
What an enticement. What are you going to give them, Josh, for being...
I got nothing. Can we give him a t-shirt? Should we make it an educated homebuyer t-shirt?
The problem is I'm out of large sizes. So if you're small or medium or extra large,
so if you're a small person and you are our 2,000,
if you're
subscriber.
large, we wear a large and you're a male, there we don't have a lot of them. Women, I don't know if we have any larges at all. We have mediums and smalls, but nevertheless, there are t-shirts available. But how are we going to know who's 2,000? That's the thing. We would have to take somebody being honest. So if you're the 2,000th sub, email us and we'll send you a shirt. How's that?
We're going on the honor system though. Maybe you take a screenshot.
Listen, we're honorable here. We want honorable people. Like we trust that they're honorable. It's
hey, if we got to go buy 50 educated homebuyer t-shirts, that'll make us happy. If we see one of you guys out there on the street with our t-shirt, we will run up and probably kiss you, and you'll be like, "Hey, get away, Spanish soccer president! You are suspended. You are not allowed to do that."
Too funny. All right, guys, that's where we are. If you haven't checked out the Educated Homebuyer podcast, do that. We actually got some new gear coming. Actually, a little cooler than this, some hats, some different things. So stay tuned for that. If you're watching this on the Educated Homebuyer channel, which is streaming there as well, go check out Jeb's channel, my channel, which is where we're also streaming this. Listen to us on Spotify, listen to us on Apple, leave a review. That's important. We're at 70 reviews or so on Spotify. The more we get, the more traction, the more people listen, the more we grow, the more we'll be here. How's that?
Just please don't be our second 1-star review calling us boomers that are out of touch. Out of touch white boomers, I believe is what that
It's probably somebody here. Anyway, guys, if you need us, there's a link scrolling the bottom. If you need anybody, real estate, mortgage, you can use that link as well. Appreciate you. Appreciate the support. Appreciate you guys being here through all the technical difficulties over the last couple of weeks. We'll be back again next Wednesday, hopefully with some better rates. Until then, adios.